Everyone says it's inflation. Too much money, not enough goods. A supply shock here, a central bank mistake there. Maybe it's geopolitics, China, oil, the usual suspects. But inflation isn't the disease, it's the fever. It's the symptom that shows the body is already sick, that the debt cycle is breaking down. Here's the paradox. You're told the world is recovering, that rate hikes are cooling the economy, that central banks are winning. And yet, the U.S. federal interest bill just crossed $1 trillion per year. That's not the total debt. That's just the annual interest. And it's growing faster than military spending. This isn't policy. This is arithmetic. And arithmetic, as history shows us, always wins. Now zoom out. What do we actually see? We see governments borrowing to pay the interest on past borrowing. We see currencies getting weaker, not because of war or panic, but because of math. We see markets acting like everything's normal, even as sovereign debt rolls over like a dying empire. Ray Dalio warned about this. He called it the long-term debt cycle, a 75 to 100-year rhythm of borrowing, boom, illusion, and reset. And he's not the only one. Charles Kindleberger, Hyman Minsky, Jacques Rueff, they all saw it. Not as theory, but as recurrence. Because every empire, every system, every monetary regime always runs out of trust before it runs out of money. The real reason for what's coming in 2026, the first true shock of this cycle, isn't about inflation targets or interest rates. It's about 5 historical flaws that repeat in every debt system before it breaks. If you look at France in 1789, the US in 1929, or Britain in 1967, the fingerprints are the same. A growing debt burden, a financial elite protected at all costs, a public convinced it will all be fine, and a delayed reckoning until suddenly it's not. The clock is ticking, but we've seen this movie before. It always begins with the illusion of control and ends with a currency no one wants. To understand why this collapse was inevitable, we have to go back, not to 2008, not to 1971, but to 1944. Inside the Mount Washington Hotel in Bretton Woods, New Hampshire. Here, as World War II still raged, 730 delegates from 44 nations met to decide what the global financial system would look like after the smoke cleared. And the decision they made was simple, dangerously simple. The US dollar would become the world's reserve currency, but it would be backed by gold. Not all currencies, just the dollar. Everyone else? They would peg their currencies to the dollar. It seemed clean. American gold reserves were massive, over 20,000 tons, and the U.S. economy was half the world's GDP. But a system born of war always carries hidden debts. From the start, the flaw was structural. The U.S. promised convertibility to gold while also printing dollars globally through loans, aid, and military spending. That's not monetary policy, that's empire building. The Federal Reserve, the World Bank, and the IMF all emerged during this time as enforcement arms of the new order. And quietly, in the background, a cycle began. More dollars flowed overseas to finance U.S. trade deficits, Cold War military bases, and reconstruction loans. Foreign central banks took those dollars and parked them back in the U.S., buying treasuries, U.S. debt. The U.S. printed, spent, and borrowed. Other nations worked, exported, and saved. This was the start of the long-term debt cycle, just as Dalio describes it. It always begins with creditworthy trust, and then the slow erosion begins. By the 1960s, France, under Charles de Gaulle, began to suspect the game. He famously demanded gold in exchange for US dollars, shipping literal tons of metal across the Atlantic. Because he saw it. The U.S. had printed more claims to gold than it had gold, just like every debt empire before it. This culminated in 1971 when Nixon closed the gold window. From that moment on, the U.S. dollar was backed by nothing but faith and debt. But here's the twist most people miss. This wasn't the end of the system. It was the beginning of its second, more dangerous phase. Because once the dollar wasn't restrained by gold, it became the ultimate collateral. For debt, for derivatives, for shadow banking and emerging markets and eurodollars and trillion-dollar asset bubbles. It allowed governments, corporations, and banks to leverage the future without limit, and it created the illusion of infinite growth. But every time you borrow from the future gets smaller. Dalio maps this perfectly. In the early phase of the debt cycle, borrowing is productive. It builds factories, highways, real assets. Then comes the speculative phase, borrowing to buy assets that are already inflated. Finally comes the desperate phase, borrowing to pay the interest on past borrowing. That's when the debt stops being a tool and becomes the system itself. From 1980 to today, we've watched this in real time. In 1980, the U.S. federal debt was $900 billion. By 2008, $10 trillion. Today, over $34 trillion. And that doesn't include unfunded liabilities like Social Security or Medicare, which push the true debt load to over $100 trillion. So how did this happen? How do supposedly rational governments let this balloon out of control? Because the system rewards delay. No politician wants to raise taxes or cut spending. No central banker wants to trigger a crash on their watch. So they kick the can with stimulus, with QE, with artificially low interest rates. And with every kick, the pile of IOUs grows. But this is not new. In 18th century France, they did the same, printing assignats backed by national land. At first, it worked. Then came inflation. Then hyperinflation. In Weimar Germany, same pattern. Borrow, print, collapse. In Rome, debase the denarius until no one accepts it. The pattern is always the same, because the logic of debt does not change. What changes is the scale. In 2024, we're at the end of the longest debt cycle in modern history, and according to Dalio's framework, this is the moment when trust evaporates, not all at once, but in waves. The first shock is psychological. Then the market reprices everything. And here's where the first fatal flaw appears, the lie of sustainability. We were told the U.S. could borrow forever because it controls its own currency. But control doesn't mean immunity. A drug dealer controls the supply, but eventually overdoses. The system needs more debt to survive, but each round delivers less and less growth. That's not power, that's dependence. And the moment interest payments overtake investment, the game flips. Everything looked fine. Markets were booming. GDP numbers glowed like neon signs. The debt, we were told, was manageable. And even if it wasn't, modern monetary theory whispered a new gospel. We owe it to ourselves. But here's the trick. Every phase of a debt supercycle has a moment where it feels like a golden age. That's the illusion. That's the trap. From the early 1980s to the mid-2000s, it looked like the U.S. and the world had discovered a kind of financial perpetual motion. Rates were falling, credit was flowing, mortgages, student loans, credit cards, corporate bonds, all expanding. It seemed like debt was the new wealth, but it wasn't. It was wealth pulled from the future and handed out in the present, a slow national payday loan. The illusion ran so deep that by 2005, central banks believed they had engineered the Great Moderation, a world of low inflation, stable growth, and high returns. What they had actually built was a debt-fueled pressure cooker, barely holding together with zero interest rates and confidence. Look at the data. From 1980 to 2020, U.S. productivity grew slowly, around 1.5% per year. But financial asset prices, stocks, bonds, real estate, exploded upward. How? Leverage. Corporations borrowed cheap money to buy back their own shares. Consumers borrowed to upgrade lifestyles. Governments borrowed to paper over economic slowdowns. But here's where it gets subtle. It wasn't just about spending. It was about replacing real economic growth with credit expansion. The financial sector, once a middleman, became the engine. Between 1980 and 2008, financial industry profits rose from 10% to over 40% of total U.S. corporate profits. Banks no longer served the economy. They extracted from it. And who benefited? Not the average worker, whose wages stagnated, not the small business owner, squeezed by rising costs and falling margins. It was the asset holders, the debt issuers, the top 0.1% whose wealth ballooned with every asset cycle. The top became flush with collateral, the bottom became buried in liabilities. And that was flaw number 2, the concentration of gains in a system funded by public debt. Just like 1920s America or Britain during the South Sea bubble, speculative booms always begin with real innovation. Railways, telecoms, the internet. But then comes the leverage. Then the pyramid of promises. Derivatives, mortgage-backed securities, junk bonds. Financial instruments so abstract you needed software just to price them. It wasn't capitalism anymore, it was alchemy. Turning debt into apparent wealth, then selling it as risk-managed growth. But the final ingredient in the illusion, and maybe the most dangerous, was the faith in central banks. Because every time a crisis began, from the dot-com crash to 2008 to COVID, the solution was always the same. Lower rates, add liquidity, buy assets. What was once emergency policy became standard operating procedure. Between 2008 and 2020, the Federal Reserve's balance sheet expanded from under $1 trillion to over $8 trillion. QE was supposed to be temporary. It became permanent. They called it supporting the economy. What they were really supporting was the asset pyramid. Ray Dalio mapped this in his writings. Once the central bank becomes the buyer of last resort and interest rates approach zero, the only lever left is currency devaluation. Not through official announcements, but through silent inflation, stealth default, and financial repression. In other words, they make your dollars worth less so they don't have to pay the full debt back in real terms. It's been done before. Britain did it in the 1920s after World War I, returning to the gold standard at the wrong price, then inflating away debt after abandoning it. France did it in the 1790s. Rome did it with clipped coins and lead mixtures. And America, the modern empire, is following the same script. But here's what made this cycle uniquely fragile. It coincided with a demographic cliff. Boomers retiring. Fewer workers supporting more dependents. More entitlements, fewer taxpayers. Which means more borrowing, less productivity. And yet, markets kept rising. Why? Because the illusion was powerful, because the system was rigged to look fine until the very end. The bond market didn't collapse because the Fed was the buyer. The currency didn't crash because other currencies were even worse. But this is the third fatal flaw. Relative decline hides absolute decay. People compare the dollar to the euro or yen and say, see, it's strong. But compared to gold, to real assets, to actual purchasing power, it's been quietly bleeding for decades. This is what you feel when you can't buy a house your parents could, when your rent is 40% of your income, when a college degree gets you debt, not freedom. The prosperity was real, only on paper, built on debt, subsidized by future taxes, and now that future has arrived. Every illusion has a breaking point. And when it comes, it doesn't care about intentions, politics, or optimism. It cares about math. In 2026, that math will hit full force, not because of a new crisis, but because the old debt finally becomes unpayable at scale. This is the point Ray Dalio calls the beautiful deleveraging. But when it fails to be beautiful, it becomes violent. We're now too far gone for soft landings. Let's look at what that means. In 2024, the U.S. government paid over $1 trillion just in interest, more than it spends on defense. Not for roads, not for medicine, just interest. That number grows automatically as rates stay high and old debt rolls into new, higher yield bonds. This is the math. In the early 2010s, the average interest rate on U.S. debt was around 1.5%. Now, new issuances are closer to 4.5% to 5.5%, and trillions of older bonds are maturing, which means the cost of borrowing will triple, even without any new spending. This is flaw number 4, compound interest in a stagnating system. Debt doesn't just grow, it accelerates. And when the growth it's riding on slows down, it turns into a wrecking ball. You don't need a war. You don't need a Lehman moment. You just need numbers that no longer balance. and they aren't balancing. Corporate defaults are quietly rising. Consumer credit card delinquencies are back to 2008 levels. Commercial real estate is cracking. Student loan repayments are resuming, with millions already in arrears. But the deeper collapse is in confidence, not just in the currency, but in the idea that anyone is in control. Let's pull a historical mirror. France, 1789. The revolution didn't start because people wanted liberty. It started because the government couldn't service its debt. Years of war spending, lavish court costs, a tax system where the rich paid nothing and the poor paid in blood. By the time Louis XVI called the Estates General, the budget was 50% interest payments. Sound familiar? They printed paper money, assignats, backed by confiscated land. It worked until it didn't. Prices rose, faith collapsed. The money died. And with it, the monarchy. Or take Germany, 1921 to 23. Reparations from the Treaty of Versailles, massive external debts. The government couldn't raise enough tax revenue, so it printed, until a wheelbarrow of marks couldn't buy a loaf of bread. What happens next isn't just economic, it's social, because when the numbers break, the narratives follow. In Dalio's long-term debt cycle, this is the phase where internal conflict emerges. You get polarization, class resentment, and populism. Blame shifts to the rich, to foreigners, to the system itself. But always after the debt has made the crisis irreversible. We're already seeing it. Calls for student loan forgiveness, talks of wealth taxes, universal income, central bank digital currencies. Not solutions, symptoms. Each a sign that trust is failing, and something more authoritarian is rising to replace it. And here's the brutal irony. The same institutions that caused the problem, central banks, corporate lenders, political elites, are the ones now tasked with solving it. That's like asking the arsonist to run the fire brigade. We saw this after 2008. Too big to fail became too big to jail. Banks were bailed out, CEOs got bonuses, and the public, they got austerity. But this time, there's no room left for bailouts. The debt is too big, the rates are too high, the math has turned. This is flaw number 5. Systems that outgrow the political courage required to fix them. No one wants to be the leader who cuts spending, raises taxes, or tells the public the free ride is over. And so, delay becomes the policy, until delay becomes collapse. If you're hearing this in 2025, understand this isn't a forecast, it's a pattern. In 1998, Russia defaulted after trying to prop up its currency through artificial interventions. In 2001, Argentina collapsed after years of pegging its peso to the US dollar, creating an illusion of strength that drained its reserves. In 2022, Sri Lanka defaulted, not from war, but from years of bad debt and hidden inflation. Each of these followed the Dalio blueprint: too much borrowing, declining productivity, desperate policy. Then pop, trust vanishes. Now the biggest borrower in human history, the U.S. federal government, is nearing the same wall. 2026 marks the point where the illusion of control runs headfirst into the math of debt rollover, where markets stop pretending debt doesn't matter and start asking, who's going to keep buying this? And when there's no answer, rates spike, markets freeze, currencies move, and the safe system no longer feels safe. It always feels sudden, but it never is. If you've read this far, you already know more than most. Now ask yourself, what happens when everyone sees it at once? If this part connected the dots between debt, trust, and collapse, drop a comment. Let's map how far this cycle can go. You're not living after the collapse, you're living inside it. Because the collapse of a debt cycle isn't always a loud bang. It's often a quiet erosion, a slow draining of options, a narrowing of choices, masked by official optimism and financial jargon. It's not just happening to the system, it's happening through you. That's the real consequence, and it's global. Governments today still talk about growth, recovery, and target inflation. But underneath the surface, they're managing decay. Here's how you know. Since 2020, central banks added $25 trillion in liquidity to the global system. But real wages, flat. Home ownership, falling. Debt to GDP, exploding. We were told it was pandemic stimulus, a one-off emergency. But the mechanism was older. It's the same logic from France in 1790, or Rome in 250 AD, or Argentina in 1989. Print, devalue, inflate the asset bubble. Hope nobody notices that the currency is quietly dying. In 2025, it's not just the US playing this game. Japan has 250% debt to GDP and a central bank that owns half the bond market. Europe is held together by ECB bond buying, without which Italy and Greece collapse overnight. China is bailing out local governments using shadow credit and off-book accounting. And emerging markets? They're trapped between rising dollar rates and collapsing export demand. It's a global, synchronized debt regime, and the illusion is cracking. And here's the bitter punchline. The only thing keeping this debt cycle alive is trust in fiat currencies. Not trust in gold, oil, or labor, but trust in digital numbers issued by states. But that trust is now being spent, not earned. Just like in every dying monetary order before, the rulers have turned to financial repression, a soft form of theft that doesn't look like theft. You're not taxed directly, you're taxed through negative real interest rates. You save $1 and inflation silently takes 7 cents a year. You work harder, but your rent rises faster than your income. Your pension? Indexed to CPI, not reality. They call it managing expectations, but what they're really managing is your decline. And as Dalio warned, in the late phase of the debt cycle, governments become both borrower and regulator. They owe the money and they set the rules. So they change the rules, like capping interest rates or introducing central bank digital currencies, CBDCs, to control the flow of money, or limiting bank withdrawals for security. All of it wrapped in soothing language. This happened in Cyprus, 2013. Bank accounts were frozen. It happened in India, 2016. Cash notes suddenly became illegal. It's happening now in trial form. Programmable money, time-limited stimulus, social credit wallets. All of it justified by a need for modernization. But history tells us it's something older. Control during the collapse of monetary trust. And here's where it gets real for you. When a debt cycle dies, it doesn't just take money with it. It takes institutions. Faith in media, in politics, in fairness, in opportunity. Because once people realize the system rewards debt over savings, speculation over work, the contract breaks. This is how empires dissolve, not when the enemy invades, but when the citizens stop believing. Ask yourself, would a 20-year-old today rather build something or trade memes and crypto? Would a small business owner invest or wait for the next stimulus? Would a voter trust their leaders or wait for the next circus? This is the echo of collapse. Cynicism disguised as realism. Speculation disguised as innovation. Decay disguised as change. And yet, this isn't hopeless, because cycles don't just destroy, they reset. After Rome's collapse came the rise of merchant republics. After Weimar came the rise of new German institutions, some dark, but others resilient. After the Great Depression came Bretton Woods, flawed, yes, but a new framework. The question is what comes next, and whether you're building for it or just trying to survive the end of this one. And if you think Bitcoin, gold, hard assets, new governance, AI, off-grid systems, or anything outside the fiat net are gaining traction, you're right. Because when trust in the central system fades, parallel systems explode in value. It's already begun. That's why Ray Dalio has shifted his portfolio toward real assets and geopolitical hedges. Why sovereign wealth funds are quietly buying farmland, energy, rare metals. Why you're seeing price moves that have nothing to do with earnings or supply. Because capital is looking for the next collateral base. The current one, debt, is over-leveraged and cracking. You are living not at the end of capitalism, but at the end of debt as collateral. If you see this cycle not as chaos, but as transition, comment reset, because naming the moment is the first step to preparing for what's next. Systems don't collapse because someone made a mistake. They collapse because the logic they were built on was never meant to last. This is the hard truth. What we're witnessing isn't the failure of modern finance, it's its natural conclusion. A debt-based system, where money is created through borrowing and prosperity is measured by credit expansion, cannot go on forever. It can only go until the collateral runs out, or until trust disappears. And here's the deepest flaw of all. We didn't build this system to create real wealth. We built it to delay consequences. Every bailout, every stimulus, every unprecedented intervention, it didn't fix the cycle, it just extended it. And with every extension, the foundation weakened. This is why Dalio doesn't speak in catastrophes. He speaks in cycles. Because this isn't new. The Dutch did it in the 1600s. Financial innovation, followed by imperial overreach, then collapse. The British repeated it in the 1800s. Debt-fueled expansion, backed by gunboats, ending in gold drain and imperial shrinkage. The US followed the same arc, but added global reserve currency privilege. That, too, has a shelf life. The next phase won't be evenly distributed. It never is. Some will lose everything they trusted. Some will adapt, shift, rebuild. And some, always, will profit from the panic. But here's what history teaches us. Arithmetic cannot be deceived. And when a system breaks because it can no longer count what's real, the reset begins. The first shock comes in 2026, not because of war, not because of politics, but because the numbers have finally outgrown the lies. If you're hearing this now, you still have time to observe, to act, to re-anchor your life in something real, not in promises, but in value. Hard assets, skills, local trust, real networks, time-tested truths. Because the empire of debt was never built to last, but the next one, maybe, can be built to endure. If you've ever felt like something's deeply wrong with the financial system, but couldn't quite explain it, this channel is where the fog lifts. We don't do noise. We trace the hidden mechanics behind crashes, empires, inflation, and resets, so that you see the moves before the headlines do. In a world where most people react, we give you the tools to anticipate. Subscribing isn't about following a channel. It's about building your own internal map of how power flows through money and how to survive when the cycle turns. Every episode adds another piece to that map. If you're watching this, you're already ahead of the curve. Now stay there.